All right, everybody, welcome into the Abundance to Give podcast. Today I have Todd Robinson, East Coast Atlanta, Georgia guy, but he's a securities attorney, called syndication attorney. He'll do soup to nuts for if you're an investor and you're looking to do all of your documents on the PSA, the purchase and sale, if you're buying any kind of commercial assets, all the way through the PPM docs if you're going to do a syndication through the SEC. He can do A to Z on it. So welcome to the podcast, man. We've been trying to set this up for a while.
It's been a while. Yeah. Thanks, Justin. I appreciate it. Happy to be here and looking forward to it.
So real quick, you said it just snowed in Atlanta, Georgia.
Yeah.
And I know we are getting a cold front right now. How is everybody doing over there? And can you even drive?
Yeah, no, we can drive. I'm looking at my neighbor's house. She's got a little bit of snow left, but it's just because it's in a little pocket of shade. But yeah, that was last Friday. It was good. Everyone had, school. Kids were out of school. Everyone was able to make snowmen and sled for about 48 hours, and then it all went away. So we're back to normal.
Are you married with kids or any of that, or no?
Yeah, no, I'm married. I've got 5 kids.
Okay. So you have a basketball team. You have a basketball team.
Exactly. Yep. I'm creating the next Harlem Globetrotters over here.
I like that.
And the oldest is 11, and I'm in a blended family. So the oldest is 11, and then we have a 7-month-old. So
okay, so you are in the hunt. So if I understand that right, you each came in with 2, and then you have 1.
Well, I came in with 3, and then I adopted her, and then we just had 1. Yeah.
Okay.
Yeah.
I love it. So actually, talking on that, what advice can you give for folks out there in a relationship that is looking for that next step that would move to a blended family? I mean, is there any advice you can give? Because it's not easy.
It's not easy. That's a good question. And I'll tell you this, it's probably going to be harder than you think. At least harder than you anticipate. And I think we've done a really good job of making it work. It kind of depends on how the ex relationships are, whether that's kosher and that impact on the core family. And it takes a lot of respect. I've always said, you probably agree with this, men need respect and women need love, right? Men need respect more than love almost. And so, a lot of it is how the blended children, but like the children of the opposite parent are viewing, they're watching the relationships and the interactions between the husband and wife, their parents, very closely. And then they may piggyback on that and treat the other member of the family in a similar manner. So
gotcha.
We just got to be on our P's and Q's a lot of times.
Makes sense, right? Because you're splitting time as well. Probably between the parents, maybe not always, but sometimes. So they're going to that family member, and then they're coming back with a different notion, right?
Mm-hmm.
And then bringing in that into this family here.
100%, yeah.
Subconsciously or consciously, that's what's going on.
Yeah.
And heck, I mean, they could have another blended family on the other side for all you
True.
know.
Yeah.
Right? So they're just one big circle of blended.
Yeah. And it's interesting, you got to treat those ex relationships like business transactions, you treat your ex spouse like you would a neighbor or someone you're doing business with, right? Your business is the kids. So how do you interact in a way that's in the best interest of the kids? So that's always of the utmost importance as well.
Yeah. And trying to remain as unemotional as possible.
Right.
That's where things, especially if it's not a kosher relationship and there is a lot of animosity there, that's going to be bad.
Yeah,
right.
100%.
It's funny because when I started dating Kate, my current girlfriend, and then vice versa, you ask each other, "Oh, so how's your ex?"
Mm-hmm. Right.
Because I was married for 5-6 years, and she was married for I think 10 or 10. And yeah, I mean, you have those past relationships that you got to talk about, and are you at odds with your ex a lot, or is it kosher, like you said, to where you can actually move on without it being crazy? So
yeah,
all the fun personal stuff in life. How long were you married previously?
So 16 years actually. Long
wow.
time.
Okay.
Yeah,
So
long time. Yeah.
Time.
We kind of the formative young adult years. I just turned 44.
Okay.
So
so you were super young.
Yeah, I mean, I guess so. Yeah, I was, 20 something, mid 20s,
Okay.
you know.
Yeah, so I guess not super young, but I guess, I didn't get married till 30, like 34. But that was
Okay.
kind of planned,
Right.
in a way planned.
Right.
But yeah, it depends on where you're from too, because I feel like West Coast Cali, we wait longer. And the
Right.
other people in the Midwest are like popping it off at 21.
Right.
So
Yeah. And culturally as well. Yeah. It just kind of depends on where you're from. But it's all good. It's all for the better, and it's good. It's all good.
So when did you, were you born and raised in Atlanta, Georgia?
No, I was born in Richmond, Virginia. And it's kind of interesting because both of my parents, like my dad has a PhD in psychology and my mom has a PhD in social work. And so I was raised in like this helping profession environment, right? And I actually have my bachelor's degree is in social work. And so we moved from Virginia to Georgia when my mom got her PhD and got a job as a professor at UGA. So that's what brought us to Athens. And so we lived in Athens in 95, starting in 95. But there's no lawyers in my family, So I got a bachelor's degree in social work. I worked for the Department of Family and Children's Services. I was a child abuse investigator. So I was in the weeds, trying to patch families together and removing children from abusive families and relationships. And kind of realized along the way, and I started, moving up in the ranks and eventually was in charge of a foster care unit in an inner city Atlanta. And it was just wild, the kind of stuff that I saw and realized that I, while I enjoyed the work and I got a lot of pleasure out of it, I wanted to make a little bit more money and B, it's emotionally draining at the end of the day. I mean, you're going home, taking all these stories with you, and it's just tough. And so then decided to go to law school. Really, the real reason why I wanted to go to law school was because I was in and out of juvenile court all the time. And I was making cases and presentations to a juvenile court judge why this child has been deprived, a deprivation hearing. And then the judge would issue an order and we'd go remove the children. Okay. And so that was my little foray into the law. And I kind of used that as a basis for like my personal statement to get into law school and all of that. And thought, I thought I wanted to do some child advocacy and things like that in law school, but ended up, once you get into law school, you just realize there's so much you can do, right? There's so many paths you can take. Right. And I thought I was going to be some hotshot trial lawyer. I was like, oh, I'm going to be, Perry Mason. I'm going to be up here giving closing arguments and things like that. But, you learn quickly that unless you're a criminal defense lawyer or you're doing personal injury, like 99% of cases will settle. So there's not a lot of actual trial work. And then I found, so when I graduated, I went to Emory for law school. When I graduated, I was doing litigation and everyone's just fighting over money. And I was like, well, this isn't very fulfilling, right? Everyone's just, you owe me money. And it was just not very fulfilling. So then I left that firm and did medical malpractice defense work, which was interesting. I was defending doctors. And that I found was very interesting because you gotta dive into the medicine. You gotta dive into, you gotta be able to talk to these doctors.
Many ways that can go, right?
Right. And then I quickly realized, hey, I'm kind of getting pigeonholed as this med mal defense lawyer. And those, as you probably know, like those insurance rates are just a lot lower, right? So your hourly rate as an attorney is just lower. And so I didn't want to do that. And at the same time, though, throughout this whole process, I was constantly networking, constantly hustling. I mean, even in law school, I was meeting with lawyers like, hey, just have lunch with me and, let's just get to know each other, right? And so I was starting to gradually build my own book of business along the way and realized that when I started getting, I remember my very first client, kind of real substantial client, was a bank. And I found them through LinkedIn. No, actually I went to a closing because I was representing like a hotel owner, and I overheard the other banker actually talk to the lawyer about some litigation they had. And I was like, oh, these guys need a litigator. Like, that's going to be me. So I found him on LinkedIn. This was, 10 years ago or so, where it was kind of a newer thing. I found him on LinkedIn, reached out, like, hey, I'd love to just grab lunch with you. We grabbed lunch. at Red Lobster, which is now bankrupt and closed down. That one, yeah. And they were like, "Well, do you know how to close SBA loans?" And I was like, "Sure, we can do that." The royal we. Like, I was in a larger firm at the time. I was like, "I'm sure somebody knows how to do it. Like, let me just say yes, and we'll see if we can figure it out later."
All right.
Right.
I call that
which is
how to show up, Todd.
What's that?
Allowing the how to show up.
Exactly.
It's never a lack of resources. It's always a lack of resourcefulness. Remember that.
I like that. Yeah,
it's
yeah.
never a lack of resources. It's always a lack of resourcefulness, because your mind could have just said, "Oh, no, we don't." Right.
Right.
And then
right.
door shut. Okay.
Exactly. Yeah.
Versus what you did do is the correct thing for any entrepreneur mindset is saying, yeah, we could probably handle that, or we can handle
exactly.
whatever. And then your resourcefulness mind kicks in, and it says, okay, well, I don't know it like right now, but I guarantee I can find some resources who do. And that's where you go resourcefulness. And then you bring it back to the table, you make things happen.
Yeah, yeah. And that's what happened. So I was like, yeah, we can do it. They put me on their list, and I started getting SBA deals as a bank attorney a month or so later, and immediately went and found the training I needed to find from other senior lawyers in the firm and figured it out, and was able to build my transactional book of business that way. That was almost a decade ago. And then since then, it's really snowballed into really a fully fledged, commercial real estate practice, real estate investment and finance practice, focusing primarily on syndications and capital raising.
I love it. That is a perfect story and like a great segue. So right now, you typically will take, let's say I was going to go buy a 50-unit apartment building.
Right.
Or, in that case, apartments. And obviously, in commercial real estate, unlike residential, the contracts aren't always just, black and white, and they're not typically using state contracts. They're all pre-written, and, obviously somewhat templated, but you then go in and you customize them for each deal.
Right.
And that's where you can come in, either representing one side or the other, buyer or seller, to verify that the purchase and sale agreement is what it is, make sure there's no crazy carve-outs or caveats that could screw your client. And then you can process forward for the actual transaction and manage that in conjunction with the lender to make sure the lender's getting what they need to close the loan with the transaction. Is that how I understand it?
Yeah, 100%. Yeah. I mean, what I tell my clients is, look, just send me the LOI once it gets accepted, and I will quarterback the rest, because I can handle the entire thing until we close the deal.
Right.
And I always, I have a whole presentation I've given at various, multifamily investment conferences about, it's called documenting the deal to the buyer's advantage, because the very first step is preparing these attorney drafted contracts. I think you're a broker. You have your broker's license. I have this whole soapbox on just say no to broker contracts. Almost like we learned as kids, just say no to drugs. Well, I say just say no to broker contracts, because they are. And I've done the Georgia Association of Realtor forms, Texas Board of Realtors. All these realtor contracts are just so poorly drafted in the buyer's favor. They protect the brokers and they protect the seller, because the seller's the one that hired the broker, but they just do a really poor job of protecting the buyer. And there are reps and warranties that are typically not in those contracts.
Right. And I always tell people, man, I said, read your reps and warranties.
Yeah.
Because that's where, the seller's on the hook or off the hook based on those things. And that's why they're representing and warranting that XYZ is the way it is. And if you find out later through due diligence that that's not the case, and it's not in the reps and warranties, there's not a ton of recourse.
You're out of luck. Yeah. Yeah. One of my biggest pet peeves is, and I've had, $25 million deals terminate because of this, is that the seller needs to provide bank statements in the due diligence. We can look at a T12 and a rent roll all day long, but until we can tie the deposits to the rent roll, it's really meaningless, because it's a man-made, manipulated spreadsheet. And a lot of sellers will push back on that, and they'll say, "I'm not giving you my bank statements." And I said, "Well, okay, then give us just a deposit statement, right? I don't care if you're paying your cousin, $10,000 a month to be the property manager, you don't
need to show me the.
I don't care about expenses.
Just show me the deposit record for maybe the last 6 months or something.
Right, because we want to say, okay, you're saying you've collected $100,000 of rent, but let's prove it throughout the bank statements. And so the minute a seller pushes back on that, it's just kind of a red flag. And I always advise my clients, like, look, this is a red flag for me. and you want to go into every deal and, operating in good faith, and you don't think people are lying to you up front, but I've seen it time and time again that rent rolls are fudged, T12s are fudged.
Well, yeah, and then what I always ask them for is your delinquency list, right?
Right.
And then your eviction list, and you want to match all that stuff up, with your eviction filings, delinquency lists, and all of that stuff. Because when you start tying that in, then you have recourse, right? Because if they're saying, our delinquency is X and we don't have this problem or this problem, and then I always say rent rolls are cute, but show me your collections.
Right, yeah. Yeah, I mean, the difference between physical occupancy and economic occupancy, right? Those are big conditions, yeah. Heads in beds really are meaningless if you're at 50% occupancy or 50% economic occupancy.
Well, and that was the funny thing during COVID, because everybody's like, oh, man, we're at 88, 90% occupied during COVID. And I said, well, yeah, but are they paying?
Right.
Right? And
yeah.
Like, so I said, your collection sucks. So basically, you have a bunch of people. Now I understand there's a period of time, but once we got past that, like, they need to pay or it's over.
Right,
so,
100%.
I always look at the collections. I could care less about, and I even tell our staff now, because we have a challenged property at the moment, but I'm like, it doesn't do us any good to bring in shitty tenants, unfortunately, just to fill the unit, and then 90 days from now have to evict them. Right.
Yeah.
We've been turning units and delinquency issues because you're not running a good screening process correctly. Right. But I hate to say it, but it's almost better to keep the unit vacant, which yes, I get we don't want to do, but it's cheaper.
Right. You don't want to pay $2,000-$3,000 to turn it if they see you get a non-paying tenant in there that just trashes it.
Right.
So 100%.
To evict them, the process, then they usually, like you said, they usually screw it up. So you got to go spend a couple grand to turn it over. Then you have leasing commissions, you have time, lost rent, all this other bullshit.
Right.
And I just tell people, I said, I understand you want to fill the unit, but it doesn't do you any good on paper to show 90%, 95% occupied if your delinquency factor is 15, 20%.
Yep. Yeah, 100%. And this is why in the contract, when we're drafting, that's why I always advocate for attorney drafted contracts, usually not broker contracts. There is some consideration to the seller's appetite for something like that. If it's a mom and pop seller, they may not want to look at a 30-page contract.
Can you add addendums and stuff?
Yeah. So what I do, if that's the position of the seller, and I don't want to obviously kill a deal because I want an attorney drafted contract, but if my client's like, look, we gotta just go with the form. I will prepare a 3-page addendum that has the conditions of closing, the reps and warranties, and anything else in there that we need. Like one big thing especially for value add properties is a rent ready credit, right? We want a rent ready credit. So prior to closing, if there's been a bunch of move outs and there's an obligation for the seller to maintain the property in good condition, to turn units within certain time periods. Prior to closing, if there's, usually 10 days prior to closing, you go out and walk the property. And if there's 10 vacant units and they're going to cost, $2,000 to turn.
Oh, I got you. Oh, I call it a make ready. You call it rent ready.
Rent ready, make ready. Yeah. Buyer gets a credit for those units that are going to cost them money to go turn them. Right. That's typically not found in a broker contract. No. Usually, yeah. Usually not controversial, but again, something that you'll need to see in a
100%. Yeah. That's a big ticket. Because even if they agree, and the other thing too is, guaranteeing kind of the rents in a way.
You can have collection contingencies and occupancy contingencies, especially if you're going for agency financing. That 90% occupied in 90 days. I mean, if that's the financing plan, then that absolutely needs to be baked into the purchase contract. Because if it dips below, you lose your agency financing.
Correct. Yeah, there's so many little caveats, and that is why when you get into the commercial space, you tend to have attorney written contracts versus the normal state broker drafted, or at some point they were drafted by the state attorneys, but like anything, they're very, very generalized and state driven, so they're not going to have all the detail per deal. So
right.
What can someone expect on average? I mean, I don't want to throw you into the ring of it, on average for a transaction attorney to cost.
Yeah. Well, it kind of depends on the scope of work. So when we are doing our securities offerings for those individuals that are raising capital privately from passive investors, that we flat fee that at $12,500, and that includes really all the corporate work you need for a lender. So the limited partnership agreement that your investor is going to invest into, the GP operating agreement where it's either you or your partners, the PPM, the subscription docs, the investor questionnaire, all the correspondences with the SEC, the filing of the Form D, and all the Blue Sky filings post-closing.
Blue Sky filings and stuff too?
Yeah. Well, Blue Sky, that includes that. It doesn't include the fee, but the act of doing it will handle it, and then the fees are charged to the client. Yeah, so that's 12.5, and if it's a smaller deal, we'll have some transactional costs just for reviewing the purchase contract, handling the closing, and just getting all that done. It really just kind of depends on the size of the deal. Like larger deals, that require certain types of loan opinions, attorney draft, when you get into those larger ticket items, it's kind of hard to forecast what that would be. And especially if you're dealing with JV partners or institutional equity.
Well, multiple states and stuff like
that. Yeah, multiple states, yeah.
Opinion letter over here and opinion. But what he's referencing is typically when you're getting into, let's call it a 100-unit deal. For simple.
Right.
Maybe it's less than that depending on it, but give or take a 100-unit plus deal, the intricacies get a little bit bigger. The lenders are more stringent. The process is more detailed. So you could, run a $50,000 to $80,000 legal bill by the time you're said and done. It happens all the time.
Yeah. That's pretty high, but I would agree. Yeah. Typically I would say if it's something like that, we're in the, $15,000 to $25,000 range. Because we're pretty efficient in what we do as well, because we just wash, rinse, and repeat. But yeah, 15 to 25, I'd say. And the benefit of
you're having to quarterback the opinion letter. So let's say you're in North Carolina and the deal's in Texas, and then you have to get an opinion letter in here and there and there, and then you have to get those attorneys to give the opinion letter because it has to be local, and they're charging $4,000 or $5,000. This person's charging $4,000 or $5,000. You guys are charging your 25, which makes sense. By the time it's all said and done, you're at 50.
Right. Oh yeah. All in. Yeah. And it's all, this is all to protect the lender, right? This is over the years, lenders have gotten savvier in what they need to protect them and protect their collateral and protect their loan. And so in a typical case, if it's a larger deal, loan docs are governed by New York law. So you need a New York loan opinion. The borrowers have to be formed in Delaware because that's where the lender wants it formed. So you need a Delaware opinion. And then wherever the property is located, if it's Texas or California or wherever, you need a local opinion. So at least 3 opinions right there, which, some borrowers just like, this is insane. Why do I have to have all these opinions? And it's just lenders being lenders.
And they got to run around and do a bunch of, LLC work and make sure that the LLCs are in good standing and this and that.
Right.
Holy crap. I've been through a handful of those, and thank goodness you have the transactional attorneys. They're worth their weight in gold. When you have good ones that know what they're doing and can, like you said, quarterback the process, and allow you as the syndicator, the person running as a general partner, to focus really on the relationships, capital, focused, and then the property, right? So you need to make sure that you're doing your due diligence and inspections and walking it properly, and not having to worry as much with the legal side and the communication with the lender.
Yeah,
right.
100%.
If you can't get your loan. Right, you're 65, 75% debt. That's the hugest piece of it. And then you're focused on the rest of the equity. If you can't get that loan because you don't have your ducks in a row, it doesn't matter what you're doing.
Right, deal's not going to close. Exactly.
I love that. But you've been teaching people. Like, do you have a program, mentorship? Looks like you're setting that up, which I love. But how's that going?
Yeah, it's going really well. It's kind of a newer thing for me, and it was really kind of organically created based on, just conversations with clients, existing clients, colleagues in the industry, and coming across a lot of individuals that really need some one-on-one hand-holding on how to go buy multifamily or how to go buy real estate deals. And realizing it doesn't make sense to have an attorney-client relationship to do that. Right. I'm not going to charge you $500 an hour to mentor you. That seems ridiculous. Right. So I created a mentorship program for that purpose. It's very small, kind of limited. And I've got a bunch of students. I've got some students here in Atlanta, some in Delaware, some in Texas, kind of around the country. And the idea really is almost a funnel into the firm as well, because I'll mentor it. And we kind of have like a 90-day program where you come in, you learn. It's really for those wanting to use other people's money to buy real estate.
OPM.
Understand syndications. We have really a 12-week action plan. You come in through the program, get access to my personal network of vendors and brokers and equity and lenders and whatnot, and then get a deal under contract or under LOI at least within the first 90 days.
Yeah.
And then you're off to the races at that point. So it's kind of a newer thing for me. I haven't, I've been mentoring people my whole career, but I haven't actually formalized it before.
Yep.
And I get a lot of joy out of it, a lot of satisfaction.
Well, and and I get the same thing because the fulfillment side of it is huge.
Right.
When you get to see people have success that you've helped guide, and then they're winning.
Right.
And then by nature of winning, then they usually want to win again. And then when they win again, then they naturally want to go bigger, right?
Right. They want to
Most
scale, yeah.
Folks, I'm sure, are starting in kind of that 10 to 50 unit space.
Yep.
And then they'll execute.
Yeah.
They'll kind of get the taste and go, oh my gosh, this is incredible. Like,
yeah.
Do it again. And then they do it again and they're like, oh gosh, like, so this 10 to 50 unit stuff's cool, but if we went here, we could probably add a couple more zeros to this game.
Yeah, 100%. And it's
they start to salivate. But usually that's when you get to that game, you definitely need co-general partnerships and co-partnership stuff, because most people are not taking down a 10, 20, 50 unit, or I'm sorry, a 10 to $20 million deal on their own.
Yeah, 100%.
Right. It's absolutely with OPM, but even beyond that, the main partners are OPMing too. On the general partnership side that's controlling the deal. Yeah.
Right. Yeah, no, that's a good point. I mean, strategic partnerships are absolutely critical to scaling any real estate company, right? And whether you're partnering with capital raisers or partnering with someone else that's got other expertise that you need within your general partnership, it's absolutely something that's important. And I love, I was talking to a guy yesterday. He's a teacher, 35-year veteran teacher. He's like, yeah, I teach, but like, I want something more, right? I want to leave something for my kids. He's a math teacher down in Florida. And I was like, man, you would be perfect because, you can do this on nights and weekends. If you've got the time to go in and there's an onus on you. Look, I'll give you some assignments to do. You need to go research. I'll give you some brokers to talk to. I'll make some introductions for you, but it's on you to, it's on you to do the groundwork. But just being able to provide that sort of, that avenue of financial freedom to people is huge. And I know you do the same thing. And I love, your Multifamily Strategies is an amazing group I've heard, and people that go into that program absolutely come out rock stars. So that's awesome.
Yeah. And ours came about, I loved how you said organically, because what I wasn't going to do, and what I was so adamant about, was being this online guru guy,
right?
That's just selling courses and mentorships, but not actually doing it.
Right.
And I can't tell you, and I know this now because I've been around the education space a bit over the last couple of years, and I talk to all these people that are deep into it at a super high level. And they're telling me, Justin, there are so many gurus out there that aren't even doing what they actually teach, but they're teaching it, right? They're teaching and they're getting paid a crap ton of money to do it.
Yeah.
But they don't actually do it. And I'm like, how does that work?
Right.
I mean, at some point, doesn't your students smell the bullshit?
Exactly.
I don't know. But they're like, well, yeah, but they just keep turning through people because it's about the money.
Well, there's so many, what is it, like 3 billion? Yeah, 3 billion eyeballs a month or something, on the social media platforms. Yeah, well, to your point, I mean, I own 750 units personally. We just sold 100 units about 2 months ago. Yeah. In Carrollton, Georgia. Bought it for $5.9 million, sold it for $10.4. Bought it in 2020, sold it in 2024. I found the deal. It was, one of the strategic partners I found the deal through off market, through a broker contact. I brought two partners in that helped raise the capital. Yep. I was a guarantor on the Fannie Mae loan, so I've got the credibility with the agencies, and we hit it out of the park. And in the meantime, I own, a property management company that we bought during COVID, and I own another process serving company, which is like a legal process serving company. in addition to my law firm, which I started the firm with a laptop in my basement in 2018, just me. Back then I could go do yoga in the afternoons and it was, it was just me. And so now we've got, 25 staff members and we've grown the business exponentially. And again, same strategy though, right? Adding on partners, adding on other originating partners that can bring and add value to the bottom line. But yeah, to your point, I mean, I think some of the appeal of the mentorship program that I have is that, I've done it. I've been identified or called, you're just an entrepreneur that happened to go get a law degree. So I think that's kind of true based on, how I view things and kind of my businesses. But I think being guided by an attorney, especially when it comes to syndications and offerings, has given folks a lot of comfort in that regard.
Well, and they're getting, the key is the access.
Right, the access, yeah.
Because similar to you, I wanted people to have access to me.
Right.
So I teach all of the mentorship classes, like me, not hired coaches, not random people that have maybe done one deal and they're a student that wants to become a coach. No. That's not how it works. That's why the organic side is cool, because I had a lot of people coming, probably similar to you, coming to me over the last few years, seeing everything that we're doing and saying, Justin, can you teach this stuff? At first I said, no, I just don't have the time.
Right.
And then we ended up putting kind of some courses online that people could take at their own pace. And people loved them. They said, this is great, like your teaching style, blah, blah, blah. But I said, I really want more like hand-holding, like close mentorship hand-holding, not just course stuff. And then, of course, so I said, listen, I can't do like one-on-ones. I mean, if I do, it's going to cost, I can't, I got to trade time for money like that. So I said, but maybe if we do something where it's like a one-to-few approach.
Like group coaching kind of thing?
But one-to-few. So it's not like you're coming into a Zoom call with 200 people.
Right.
You're coming into a Zoom call with me and there's maybe 5 to 6.
Gotcha.
Right?
Yeah.
So you get a lot of attention. And the best part about that is rather than the this is what I found, rather than the one-on-one where you can't feed off of other investors and students doing deals, having that small group environment where they can actually see other students doing deals. And then there's a lot of Q&A that goes on between them.
Right.
And on top of that, you're seeing, okay, this guy's doing a deal over here. He's a little bit ahead of me in the process. He's going through this BS, so I can learn from that.
Yeah.
And then this person over here, this girl over here, and on this little small environment, next thing you know, they're partnering on deals.
Yeah, that's where the magic happens. Yeah.
Which I love. So that's why that approach has worked beautifully. And then they're getting access to me. So it's not you're going to talk to John who's done one multifamily deal and all of a sudden now he wants to coach everybody how to do it.
Right, right. And you see a ton of those guys online. Yeah, yeah,
yeah. There's so much nuance to this. It's not flipping a house or wholesaling a house. I mean, you're buying a multi-million-dollar asset. And because of that, granted, there was more zeros, which is why people do it. It's greater upside.
Right.
But because of that, there's also a skill set and a nuance that you've got to master.
And I've heard you say this all the time, and it's so true. You're buying a business, right? I mean, multifamily is valued like a business. How much cash does the asset produce? That's your biggest number that you need to focus on, right? It's not valued, the market value is great. What does this property sell for? That gives you an idea, but the real valuation is going to come from how much NOI we're talking about.
That's right.
Right. And so, NOI. It's all about the NOI.
And I showed the students yesterday on our call because they're just understanding the financials and how it all works. But I said, let me show you the power of NOI. It's real simple. I said, let's take a 10-unit building and we do a little improvements to it here or there. We're able to bump the rents, $120 a month on each unit, right? So that's, I'll call that, it's $1,000 we're adding a month, maybe a little bit more than that, right? $1,200 a month. Over the year, that's over $12,000, maybe $14,000 over the year that we're adding.
Right.
Just straight bottom line net operating income by boosting the rents, right? Nothing else changes. We're boosting the rent. I said, you have now taken that building, put it over a 5.5, maybe a 6% cap rate, right? And now you've added $200,000+ right to your pocketbook by simply bumping $100 a month. So you got to understand how the exponential factor works on the building, because that's all you did. You literally found a way to bump the rent $100 a month per unit. which is,
Right.
1,000, 1,200 a month total, and then
Yep.
12,000 plus a year. And now you've literally just taken 200 plus thousand and stuck it in your back pocket.
Well, I mean, it's the same strategy as Blackstone uses, right? Buy it, fix it, sell it. I mean, you can break it down that easy. It's the same strategy. Look at Steve Schwartzman. You read his book. I mean, it's the same thing. You buy it, you fix it, sell it. Now you got to buy it right. That's
Correct.
the biggest thing, right? You got to buy it right. Can't buy it at the top or buy it wrong.
Yep.
Make sure the fix is appropriate. And then what I always tell people is, you got to leave meat on the bones. Right. If you're implementing a value add strategy and you're going to go upgrade, this 40 unit, you're going to upgrade 20 kitchens, and you think you can get $300 more a month. Well, do it, prove your strategy, and then hit your numbers and leave meat on the bones. Because if you upgrade all the units, then who's going to come buy it? Right. I mean, everyone's looking for that opportunity.
Going to buy it as somebody that maybe wants to operationally, but you're not going to get maximum dollar.
Right.
So you'll get a good dollar, but not maximum dollar. But you said, prove the strategy, right? So you have procurement in the numbers, and you can show the bump in rents over X amount of time with X number of units by implementing the strategy. And then you're right. There's always going to be somebody that also wants to come in and take it the next step.
Yeah. I'm currently doing one-on-ones with everyone, and it's almost to the point where I may have to move to more of a group setting. But we have a group call on Tuesday nights, but then I'd
small. A small, a one to few, I call it.
It's
not, you're not getting on a Zoom with 200 people because you're not going to get the access.
You're not going to get the access, exactly.
You typically 8 to 10 on a call max, and then there's a lot of great Q&A that goes on with that, which I've found has been amazing, because you'll have like one student come on, show his deal or their deal, go through the problems. I'll help them through the problems.
Right.
And the other 3 or 4 students on the call are like, oh my gosh, like, thank goodness you went over this deal today. Because I'm looking at this one, looking at this. I hear this problem. Now I can fix this and do this. I wasn't thinking about that.
Right.
So that kind of live interaction with a few people is killing.
It's gold. Yeah. I've had that as well. It's interesting. One of the biggest things we talk about is, raising capital, right? And how do you raise capital? How do you go find investors? And there's lots of ways to do it. And in this day and age, it's you go tap your friends and family first, I think. I mean, everyone does, right? I've got a rich uncle. I've got, my cousin just is a, $1 million W-2 guy. Go through your network. And what I'll first do is I will go with our students and I'll say, let me see all your Facebook friends. Let me see all your LinkedIn friends. We'll print it out and we'll say, look at all these individuals that you have immediate connection with.
Yep.
And see who you can run through there. And then the other idea, and I actually got this idea from a student. She was brilliant. She hosted a party, like a dinner party, but she had a theme. It was called like influencers and connectors or something like that.
Yeah.
And she just invited everyone that she knows to her house, almost for like a subtle, she wasn't pitching a deal, right? She was deepening and nurturing her relationships with her existing contacts and letting everyone know, hey, I'm a real estate investor now. I'm going to syndicate transactions. I may call you later for some money. Yep. And it was a great idea. I was like, that's brilliant. She probably had 50 people come to her house.
It's an indirect way of networking rather than going to a networking event.
Right. Host them. And if you're thinking from a 506B perspective, which is the kind of the friends and family exemption under Reg D, in that offering, you can only have 35 unaccredited investors and 100 or as many as you want accredited investors. But the key is you have to have a pre-existing substantive relationship. And so people always ask me, well, what is that? Well, the SEC doesn't give us the playbook on purpose because they want to keep their enforcement jobs. So they don't tell us what it is, right? But we've read the tea leaves enough to know typically there's a 3-touch rule. That's what it used to be back in the day. And okay, I've met them in person. I've had coffee with them, and I've sent them an email. I talked to them on the phone. Yeah. Then you can consider them a pre-existing contact, and they can be one of your investors in your 506B offering. But the idea of hosting this dinner party, getting everyone coming to your house, having a personal invitation, personal relationship, I would argue that is establishing a pre-existing substantive relationship.
100%.
Right?
Yeah. And as you know, it's a very gray line. It's a very gray line. The ultimate purpose for why the SEC has put all this stuff in place. If you just think about it from a logical perspective, they don't want you taking grandma's last 50 grand.
Yeah.
Okay. And sticking it into a deal. And then all of a sudden it goes south and that's the last 50 grand she has. Okay. That's what they're trying to avoid, is the American greed show of grandma's last 50 grand.
Right.
And so if you just come at it from that perspective of, listen, got to talk to your investor people. If they're trying to give you their last 25 grand because that's all they got, you say, no, like, this is not what this is designed for. Right.
Risk.
I mean, it's limited risk, but there is risk. So if that's all
100%.
you have, this is not the mechanism for you. Like, we want you probably to do some other things first and then, come into this.
Yeah. And to that point, there's a level of sophistication even in the unaccredited investor analysis, right? I mean, to be an accredited investor, you have to have a salary of $200,000 or more if you're single, $300,000 or more if you're married, or a net worth of $1 million or more, excluding the equity in your primary residence. So if you meet that qualification, you are considered an accredited investor. Now, in a 506B offering, you're allowed to take in unaccredited investors, but you can't advertise. That's the rub from the Jobs Act of 2012. You can only advertise in a 506C.
Yeah, what they don't want is what you're talking about. Going on Facebook and YouTube and pitching something, and grandma wants to give you $25,000, but it's the last 25 she has.
Right. Well, yeah. I even use the example when I speak on this topic is even if your neighbor is a school teacher and she, her uncle left her $10 million, and you find that out at the neighborhood, get together. She really, I mean, in a 506B, she's your neighbor, her, she would qualify as one of the 35 and in fact, she'd be an accredited investor, but she doesn't have the sophistication of understanding finance and real estate. And so, so if you go and get money from her and things go south, there absolutely could be some sort of claim from her. Well, I don't know. I just gave money to Johnny and he told me to make money for me. Right.
Gotcha.
So there is some onus on the sponsor of, okay, who you're getting money from, they need to actually be investors, and have an understanding of this process.
Sure. No, that makes complete sense.
Yeah,
I like that. But yeah, it is a wild space. I mean, I was just talking to a buddy that was here yesterday, and he and his family, had $500,000, essentially stolen from him by, a shady syndicator, and I'm just like, it's just wild to me. It's wild to me that whoever's doing this can justify it in their brain. Because if you talk to a lot of these Ponzi scheme people and bad syndicators and shady people, they initiated their businesses under good terms and good faith and good intention. Okay.
Right.
And they tell you this. I was running a legitimate business and then things got tough and tight and blah, blah, blah. And then I made the decision and I went this way. And I said, that's exactly right. You made the decision and you went this way.
Yeah.
Versus having a little bit of cojones, having some courage, and going and talking to your investors and saying, we're having XYZ problem. Okay, this is what's going on. What would you like to do? Right?
Yeah, 100%. I mean,
It takes courage. Yeah. And it takes owning up to, maybe I'm not running things all that great at the moment, right? I'm doing my best, but things aren't going great. So how do we have this conversation to kind of make things better? Because if you come at that, most investors, while they may not be happy, they're going to be like, okay, like stand-up person, let's work through the problem, let's try and find a solution and not have things go south. Versus the other option is you don't tell them anything and you put on a hunky-dory face and you go start commingling money all over the place.
Right. And I've represented on both sides of that equation. I've represented the limited partner who's been screwed, and I haven't represented, let me back that. I haven't represented the sponsor who's screwing people because I wouldn't do that. But I have sued, on behalf of my clients, many a sponsor who have just absconded with the money, and they're just robbing Peter to pay Paul. I mean, I've got one classic example. I mean, I've got a $5 million judgment against the guy right now, and he's out here trying to save his tail. He's going to face the music eventually. He'll have to file bankruptcy eventually, but that's like the kiss of death in this business. You file bankruptcy, you can just forget your real estate investing career because no lender is going to lend you any money. Right. But he would get investors to execute what they called an investment agreement. Right. He didn't syndicate it, didn't put them in the company. And I read it and I was like, well, is this debt? Is this equity? I can't tell. It's like there's a promise to repay. Okay. So it looks like debt, but then he's getting an ownership interest in a company, but he's not signing the operating agreement. Gotcha. And plus there's a profit interest. So then it looks like equity. It just was very unclear. And what he was doing was
initially as a promissory note.
Right.
And then there's upside equity built into the language, I'm guessing.
Right.
So then it sounds like, oh yeah, we're getting this. So there's a note to pay debt, but then there's also equity and ownership profits, blah, blah. Wow. Okay.
Yeah. So this one particular client I'm representing him, and he invested $150,000 with this guy. And his investment agreement said, I'll pay you 10% preferred return. Okay. And then when we refinance or when we sell, you'll get 20% of whatever net proceeds from the sale, which is a heck of a lot. And he offered the same thing to like 3 different people, which is what the problem is. And so what happened is the bad guy ended up refinancing. He clipped, I don't know, I forget what it was, $3 or $4 million from the refinance.
Wow.
Didn't give my client a dime and just walked away with the money. And so when I got involved, I filed, because I started out as a what's that?
Is he going to go to jail?
He should. I mean, my clients are pushing me to make a referral to the district attorney and go the criminal route. But we sued him civilly for breaching this contract, for breaching fiduciary duties, for fraud, RICO, all sorts of stuff. I started out as a litigator, so I still have those litigation skills, and I'll do it if I need to, but I don't really advertise that I litigate, but I certainly can. So anyway, I turned this $150,000 investment into, a $1.7 million judgment against this guy, because he just, he it's just, it's the thing not to do. And it's funny. The guy calls me. He's like, Todd, I need you to help me figure out how to raise capital and do this the right way. Yeah. And I'm thinking, I'm not going to touch you with a 10-foot pole until you pay all these people back. And then let's see if you survive the next 2 years.
The sponsor called you that you're
suing? Yeah. The guy that I'm suing calls me and says, can you please represent me and help me structure these deals correctly? And I said, no, I can't do that.
Well, I mean, yeah, maybe in the future, bro, but I understand, you see, you screwed up. You've admitted you've, just playing stupid, I guess, but you did legal documents the wrong way. And I mean, but the fact that you did a refinance and you pulled money out
and didn't give it to
your investors.
Yeah.
I mean, that's 101. Bro.
Right. And there's no excuse. I mean, he doesn't have any defense. He's just like, I'll pay you back. And so now,
it'd be one thing if the deal legitimately market dynamics went south.
Right.
And you were trying to do because it's all about intent, as you well know.
Yeah.
And if your intention was XYZ and just the market did XYZ, and now you're up shit's creek, and of course everybody's going to lose their money.
Yeah.
That's one thing. Versus, like you said, your intent is malice. And then you're going out there ripping people off and stealing money here and moving money here and taking money here. And oh my God.
And what's funny is he started a mentorship program as well. And then what he would do is he would do the mentorship. It was $50,000 to join. It was insane. And then he would go out, teach them how to do it. He'd find properties for them. He would get it under contract. And then he would assign it to his mentee and take like a $200,000 or $300,000 assignment fee for each deal.
Wow.
Yeah. It was just bad all around.
Was he letting him know he was getting the assignment fee?
Probably not. I don't think so. Oh. Yeah. I mean, he just hid it from him.
Probably weren't big enough to absorb that, but wow. I mean, I don't know.
Yeah. I don't know. It was, it's not a good look. I mean, this is the other side of syndication where you got to be, and as investors, especially LPs listening to this or, that you talk to or I talk to, it's so important to vet your sponsor that you're going to invest with, right? Ask about their track record. Ask about, get referrals and references. Do a deep dive Google search if you need to, or look at public records. Ask if they've ever been sued, if they've ever filed bankruptcy before. All those things are super important because you don't know who you're getting in bed with. And these are not FDIC insured investments, right? I mean, the whole point of a PPM is to disclose all the risks. I mean, I call it a PPM CYA. It's to cover your ass as a sponsor, right? Because
that's right.
We're telling the limited partners, look, we could lose all your money. Construction rates could increase. The economy could turn around. There's a conflict of interest, right? You as the sponsor, are you buying this property because you're going to get an acquisition fee or because it's in the best interest of the limited partners?
Sure.
That's a conflict of interest. That, again, is disclosed in the PPM. Now, of course, PPMs don't prevent people from suing, but it's the first document you're going to pull up if something happens to go wrong. So
that's right. Yeah. That's why I tell people, because some people pull templates offline, right? And I talked to a PPM attorney, and he says, Justin, he said, I understand the templates. That's all cute and nice. But he says, the problem is not the template. The problem is if a deal goes south and that limited partner or partner gets an attorney and they want to look into things, and that attorney gives you a call. And then the first question they're going to ask you is, well, do you have your documents? Great. Who drafted those for you? And if your response to that attorney is, well, I got a template offline, the syndication attorney, securities attorney is like, you might as well just turn around, face the wall, put your hands behind your back, and cuff yourself. Because he says if that attorney has any, legs to them, you're toast.
Yeah.
Because you're done. So that's all I had to say to that when he says, listen, don't worry about the 10, 15 grand or $7,000 or whatever it is. Because typically the way our deals work is, you pay the 15 grand or whatever it is for the first set. And then typically if you stay in the same structure moving forward or similar, that can be reduced, right?
Exactly. Yeah. If it's wash, rinse, and repeat, hey, I'm just going to execute the same strategy. Then obviously the second set's usually less and, 100%.
But it's worth its weight in gold. I'm like, guys, you're chasing, or what do they say? You're tripping over a dollar. You're chasing pennies to trip over dollars or whatever it is.
Right.
Because it's not even about that. It's about, you're about to go out and raise money from people and do legal stuff. And it's not about when things are cushy, right? Everybody's happy when everybody's getting paid.
Right.
Said, you can't control the markets. I said, as long as you're not doing fraud and the market goes south, you can't control that. But people are going to get pissed regardless if things go south. And they're going to look to sue people because that's just what people do.
Yeah.
And if you don't have your T's crossed and I's dotted, you're going to pray to baby Lord Jesus you did.
Right.
About that. So I would 7, 8, 10 grand. Trust me, just sleep.
It's so worth it.
Way, if things go south, at least your intention was good. You did everything you could. You left everything on the table, and things happen. Like you can't control things you can't control.
Yeah, I always say, there's a saying, at least in the law, that the person who represents the I don't know if it's lawyers or it's the person who represents the lawyer who represents himself as a fool for a client, right? And the same is true, for individuals, sponsors trying to represent themselves. I mean, it happens all the time. Like, and people always ask me, well, how much is this going to cost, for this document? And I always go back and say, well, how much is it worth? Right? Are you how much is it worth to you? You want a joint venture agreement with a partner? Okay. How much is it worth? Is it worth to you a lot of money if you execute your business plan in that joint venture and you sell the property for bukus of cash? Yeah. Well, then why are you coming at me for my fee? Right.
Right. Yeah.
So,
and it's just limiting mindsets, a little bit of limiting beliefs of like, I got to pay $5,000, $10,000 for these documents. I understand that. I mean, trust me, but like you said, it's worth about 10x or more.
Yeah.
So.
Yeah. I've I've been doing a lot of
First thing you're going to do when you have a disagreement is you're going to go look at the documents.
Exactly.
Right.
Pull it out.
All partners do. And when things go south, you're going to go look at the documents. What does it tell me?
Right. So, yeah. Interesting.
So, kind of 2025, what are you seeing? And we got a few more minutes here, but like, what are you seeing in the marketplace? What are some of your goals? And then, let's kind of start there.
Yeah. It's a good question. I think from a real estate perspective, I think it's still pretty frothy out there. The market, the buy sell equation is just not quite there yet. I mean, I met with a guy yesterday who's buying 3 or 4 deals, literally just for the loan amount. The loan amount plus maybe $100,000 premium, or the lender's requiring him to catch up all the default interest, which is like $150,000. Okay. Pay $100,000 premium to the seller, and then you're buying a $6 million property for $250,000. Wow. So those deals are out there. They are coming. The whole wall of maturities that everyone's talked about. There's so many deals out on the market that from 2020,
interest rates are staying high, right?
They are.
I think the hope and the pray was that, hey, if we kick the can down the road far enough, we can get some, help on interest rates, and then refinancing or changing the structure of the loan could work, and then we'll all save our butts.
Right.
So let's just fight to survive. But when interest rates are still staying super high with the 10-year treasury and all this stuff, and then values have dropped because cap rates have gone up.
Right.
I mean, we have a deal right now. I mean, thank goodness, Todd, I knock on wood. I mean, I kid you not. So we bought this deal in December 2021. Okay. We were in escrow on 2 other ones that we luckily were able to get out of because you had kind of a slumlord issue going on and they weren't disclosing things, blah, blah, blah. So we were able to pull our money away from those and not get into them because those would have been back to the bank already. Yeah. And this deal is a good deal. Great location, great property, good deal. Just bought it at the peak, right?
Right.
2020, peak of the real estate financial multifamily game. And so cap rates have gone up substantially, interest rates have gone up substantially, and values have dropped substantially. And it's short term. I mean, thank goodness we were able to get into fixed rate debt on this thing because we went into it with a renovation loan. And then by the luck of God and a lot of force by me, pushed the thing across the finish line to get it into Fannie Mae debt last year. And I'm sorry, 2023, okay. Excuse me. And now we're kind of sitting okay, but it's still a dogfight because what we're seeing now is costs have risen right across the board. This cost for running these properties, payroll, expenses, insurance, everything, right? And rents have flatlined and in some cases dropped. So you're seeing rents flatline, so revenues dropping, expenses increasing, in some cases occupancy dropping in a lot of ways too. And now you have property squeezing, right? Where they're just, hanging on, right? They're breaking even or hanging on or whatever it is. And a lot of that's going on. A lot of it's going on. So I'm curious to see at what point it pops. I
don't know. We're going to have a new president on Monday, so I don't know if that's going to help the market some. Interest rate. I can't remember a time when the Treasury cuts interest rates and they increase. That just gives you an idea of how crazy the market is. I mean, typically when rates are cut,
it's due to the bonds, as you know.
Right.
And then,
right.
If people are concerned about inflation, that's why this is happening, right?
Exactly.
So rates are dropping, but inflation's sticky, and then you have a debt problem and all these other things attached to it. So that's why it's all about the buy and sell of bonds.
Right.
So
I remember last year, kind of on the conference circuit, it was, everyone was like, oh, survive to 25, right? Survive to 25. That was everyone's mantra. Well, now it's here, and it's like, I'll see you in heaven in 27, or
I love it.
I
love it. If you actually look at the data, and we can kind of finish off on this, I don't know if you go to the website CredIQ.
Yeah, no, I haven't heard of that one. CredIQ. Okay.
CredIQ. Great data, right? They track this stuff, loans, defaults, delinquency. I mean, just
nice.
Really good website. And they talk construction starts, supply, demand, all this stuff, right? So there's a lot of markets, as you know, that were oversupplied. A lot of growth, Texas being one of them, Florida, Sunbelt states, blah, blah, blah. And that's all true. And so because of that, you're seeing higher vacancy rates at the moment. And occupancy's, down, or occupancy's down, concessions are high, rents have flatlined or dropped. And so it's a dogfight in some of these markets. Phoenix area, the Arizona markets being one of them. Nevada being another one. I don't know how Georgia is. Florida's in that circuit as well.
Yeah.
But because of that problem, it's going to get absorbed because construction in some areas has stopped due to costs and interest rates.
Right,
so you have this window that's getting absorbed now. So by 2026, if you actually look at the data, if we continue the same trend, we'll absorb a lot of that oversupply in a lot of these markets. So now you're going to run into another housing crisis problem. And that's when you're going to start to see rents rebound.
Ah, gotcha.
So person looking strictly at the data, my whole thing has been, let's get to 2026. Because
just hold out for 20. Yeah. So now you got to find something that rhymes with 6.
Yeah, you're going to see rents begin to rebound because simply supply demand. Supply demand.
Yeah.
Now, I don't know what's going to happen to interest rates because that's the kicker. You need the rates to come down so cap rates will begin to compress.
Right.
That's because if cap rates don't, you need cap rates to compress so values begin to go up, right? And then when rates go up and then you have interest rates come down, that's when things will compress. And you'll get one side of that equation. You're going to get the rents going back up. But I don't know about the interest rates, man. I don't know.
That's going to be tough. I mean, I think the 5-6 environment, 5, 6, 7 is kind of normal. I mean, I think we were so spoiled with the 2 and 3 and 4% rates that everyone thought that was normal. It's not normal. I mean, normal is 5, 6, 7 at the high, right?
And that's fair. That's fair. And so really you need a rebound in the revenue stream for a lot of these deals, and you need rents to start going back up to widen that gap, right? And allow more NOI on these buildings. Which will then allow the values to pop up.
That's right. Yeah, interesting. It's funny. I was going to ask you, how much stock do you put into cap rates? Because when I look at cap rates, when I analyze the data, that is a fungible number that's just a function of NOI and value. So your cap rate, if you want to increase or decrease your cap rate, just change your value in your analysis. So I guess it gives you a taste of where the market's at, and that's probably the biggest benefit of it. But other than that, do you put a lot of stock into cap rate when you're looking at buying deals?
You in the past, no, because you do all the value add creation, so it didn't really matter your going in cap rate.
Yeah, exactly.
But because of where the market's at today, yes, because you're not going to be pushing it at the same level you were in the past. You can't get these massive bumps, right? Unless you get some screaming deal, which it's harder to find.
There's a few far between.
So yes, you do more now. Your banks are going to look at it closer. Your investors are going to look at it closer. What's your going in cap rate versus what you're anticipating
your exit cap, right?
Because they need to be more aligned. Because you're not going to be able to buy a 3 cap and turn it in, take it up to, a 6 cap and sell back down at a 4 cap or whatever. Right. That's just not going to happen. So you need to plan for. Yeah, I mean, if you're gonna buy it at a 3, which is really tough to do. Because now you can't even service the debt, right? I mean, most guys, you can't buy a property for less than the interest rates on it. It makes it really hard. Like cap.
Yeah, right.
You can, but usually that delta between what cap rates are and what your interest rate is, maybe 150 basis points max.
Right.
What I mean by that, that's 1.5% for people that are wondering what that is. 150 basis points is 1.5%. So if your interest rates are 6.5, you can't pay any less than a 5.
Right.
And that's like max. Usually they'll want that tighter right now. Because then you have to just put a ton of money down, right? So that way you can actually
rebalance that. Yeah.
You got to be able to service your debt. Right.
Yeah. It's interesting, man. It's gonna be crazy. We got to find an acronym that rhymes with 6. There was something.
Sexy till 6? No, I don't
something.
I don't know. Yeah, it's we'll see what happens here. But thankfully we only have one asset right now that is a dogfight.
Okay,
right? It's a dogfight. But we're in there. We're doing it. But it ain't fun.
Right. Is it a dogfight with your lender?
What's that?
Dogfight with your lender or
no? That's fine because we have Fannie Mae debt on it at 5.49%, 10-year fixed.
Oh, nice. Yeah.
So that's not the problem. It's the cash flow situation.
Oh,
right?
gotcha.
The property's tight. It's super tight because we have higher vacancy at the moment. We've come in now because I finally said enough with these third-party management companies. Most of the times we use third-party.
Right.
But I can't pay all these fees and costs for a third party. Like I'm paying for the Four Seasons, but again, I'm getting a bunch of suites.
Right.
It doesn't work.
Yeah.
So I said, guys, I'm sorry. I said, I've realized, unfortunately, with this particular property, we're going to have to bring it in-house. We just have to. So we brought in our own team, our own staff, everything, and we're property managing, and we're doing it better because I knew we could. It's just a pain in the ass to do it. And so we're in there, dogging this thing every day, making sure delinquencies down, collections are up, renewals are out, work orders in line, getting the leads and listing for the leasing side. That whole game of managing that process is not easy. So
is it local or is it in Texas?
No, it's in Texas. Yeah, this one's in Texas.
Gotcha.
So, thankfully we came in in November and took it over. And granted, going through the slow season, so that's not any better for leasing. But now we have delinquency in line. We have renewals out, 90 to 120 days out, getting renewals in line. Work orders in line under 10 to 12 at a given time on a larger asset. So our last line is occupancy. Yeah. Right? It's just getting leased up. Because I know that if we can get the thing physically occupied north of 90%, I think we're at 80, 81 right now, get to 90+%, and then we have our collections in line, renewals out, the property then will sustain itself. Yeah. It will sustain itself. But it's been a dogfight, man. And so we finally had to say bye-bye to third party. We're going to come in and run it. Like I said, took it over in November, so it's only been a few months now. But now we're finally getting things under control. And thankfully, we're going to come into the spring season, and we should get there. If we're doing our job, we should get there. Right. And then, then it's just a matter of paying back all the accounts payable.
Yeah, right. Yeah, make sure there's no liens on the property.
Yeah, right. So it's, and it is what it is, man. But you got to get in and get dirty sometimes.
Yeah, well, and it goes, kudos for you and your team for doing that, because no one's going to take care of your property like you, right? Your own property.
Yeah, no one's watching your money like you're watching it.
Exactly.
And so that's why I always ask any sponsors we invest with, and this is for anybody out there, if you are going to invest into a deal and your sponsor is not putting any physical capital in, right? That's a problem.
Right.
Okay? Because it's not so much a problem when things are good. It's when things get tight and they're like, well, I've kind of gotten all my money out of it and I got my acquisition fee and, there's not really any leg for you to stay in it.
Right. Yeah.
It comes down to your integrity. But some people are like, integrity out the window, peace out.
Yeah, 100%. Yeah, usually, and I would say usually sponsors put in 10% of the required equity, right? That's what I advise. You raise 90% from investors and try to come up with 10%.
Yeah, and for that you get 30% of the deal or 40% of the deal, and you give away the rest, and you get some fee structure built in there as well. So you're doing well if you do a good job.
Yeah, awesome.
Well, beautiful, man. Where can people find you? So that way, when they want to find you, they can come in and get in your programs and everything you're doing.
Well, absolutely, yeah. So I'm primarily on Instagram. Syndication Expert is the handle on Instagram, and then my firm is Robinson Franzman, Franzman. So you can find that online. Get a hold of us that way.
Are you planning on doing any live events this year? I'm wondering if we should find a way to collaborate, man.
I'd love to, man. I'd love to. I typically speak at Rod Cleef's events. He does I'm actually working with them on their portfolio, but I'll go down and I'll present there. I've done the Active Duty Passive Income Conference as their kind of syndication speaker, but yeah, I'd love to collaborate, man. If there's a way to get we can get something together and put a show up, that'd be awesome.
Awesome. I love that. I'll keep that in mind. I'll reach out to you. We'll figure something out.
Sounds good.
Well, beautiful, man. Yeah, go and reach out to Todd if you guys need anything in this space. Super sharp guy, and I appreciate you coming on and being a part of this today.
Yeah, thanks so much, Justin.